How's it going, friends and family? My name is Amos, and just the other day, up on the YouTube channel, I posted a poll. Not this one, disregard this one, but this one right here. I was like, hey, I'm a man of the people. What stock deserves my attention next? 51% out of the 436 said Meta. We uploaded that video. It's done. 21% said Duolingo. We analyzed the company. We uploaded it. Very unpopular opinion, but it's done. Next on the list is Texas Instruments with 19% of the vote. So friends and family, today we're going to be talking about and analyzing Texas Instruments. By doing so, we're going to be calculating an inherent worth of their stock price, but also we're going to be placing them somewhere on the compounder chart. Among all of the various stocks that we have covered on this channel, are they better than them? Are they worse than them? And then towards the end of the video, I'll be going over my game plan. If that sounds good with you, then let's go ahead and get into it. Now, for most of us that grew up in the United States and you took a mathematics course in the 80s, 90s, or even early 2000s, you probably associate Texas Instruments with the calculator. And to be honest with you, up until like 7 years ago, before I got into the stock market, that's also what I thought as well, right? But there's so much more than that. In fact, only 6% of their total revenue is made up from the device sales. So what you see on your screen right now, year to date, Texas Instruments going through a pretty rough time. But they're not alone. So many other high quality businesses are also suffering this year, to include PayPal, Adobe, Salesforce, the list goes on, right? And if we zoom back 5 years, 1.7% into the green, only taking into account the share price appreciation. Of course, if you bake in the dividends that they do pay out, their dividend yield is a 3.5%. This should be a little higher, right? Like a 4.5% year over year gain because of the dividends that were paid out. But there's natural peaks and there's natural valleys. Sometimes their stock price can go up, but it can also go down, and the cycle seems to repeat itself almost in a predictable fashion. But before I get ahead of myself, let's go ahead and talk about their business overview. What is Texas Instruments and how do they make money? It's best to think of Texas Instruments as a chips manufacturer that's based here in the United States. Their analog chips are their bread and butter, and it makes up about 80% of their revenue. Unfortunately, they do not have a wide economic moat because they face tough competition from other manufacturers. The biggest one is Analog Devices. I think it's ticker symbol ADI. And analog chips, they basically help to manage power in every setting possible, such as for charging your phones, your laptops, your TV, electric vehicles, industrial robots, missiles, drones, data center equipment, and more. And that's why when people talk about AI chips, Texas Instruments is also a part of that conversation. They're not at the tip of the spear, but they're in the supporting background cast. Like when you think about a theater production, you might only look at the actors that are singing or crying on demand, but there are the stage crew as well, right? The ones that are shining the lights, playing the music at the appropriate time. That's basically Texas Instruments, okay? And they also make embedded processing chips used in radar systems, home appliances, such as your Whirlpool or your LG refrigerator. By the way, between you and me, we need to take away AI from home appliances. I don't know about you, but I just want to keep things simple. I just want my washer to wash. I don't need it to have 20, 50, 800 features with Bluetooth and Wi-Fi, because what that does is introduce more room for failure and for errors and for it to break down. When you keep it simple, it lasts longer. I know that was a crazy opinion, but I'm not scared to speak my mind. And also, the embedded processing chips are utilized in utility meters. That way we can know how much power you use, how much water you used, and whatnot. These chips make up about 15% of their revenue. So as you can see, they're not just a calculator company, okay? If you think they just make calculators, you're very misinformed. And now let's go ahead and talk about the recent developments that are surrounding Texas Instruments. They just posted their earnings, I guess about 3.5 weeks ago on October the 21st, which is my birthday. Kind of crazy to see. And the headline says this from the Wall Street Journal: Texas Instruments warns of slower semiconductor industry recovery. The semiconductor space is not a smooth sailing sea. Okay, I think a lot of us are spoiled because of NVIDIA. But historically, the semiconductor space is very cyclical, meaning there's highs and lows depending on the market cycle, but also demand and inventory levels. But I'm getting ahead of myself because let's talk about their earnings. How did it go? I listened to it, I read their documents, and it was a mixed bag, meaning there was some good and some bad. Okay, so they missed their bottom line expectations and they lowered their guidance for Q4. So for the remainder of this year, going from October, November, December, they're not expecting it to be rainbows and sunshine. And that's why, friends and family, it's so freaking important for you to be able to understand the EPS. The EPS is that crucial. And it's why it's my preferred forecast model for coming up with a future stock price. Because in the past, I think I baked in too much emphasis on the free cash flow or a lot on the multiples valuation. And then I learned, dude, the stock market, it moves up and down, sometimes violently based on the EPS. If you miss or if you beat and you raise your guidance, that can send the stock price up or down. And that's why here in a little bit, when we calculate their intrinsic valuation, I'm going to be focusing a lot on the EPS. And if you're anything like me, you're a visual learner. So right now I'm on stockanalysis.com. By the way, I have a referral link down below. If you click it and use it, you'll get a discount on top of whatever promotion they've got going on. I'm going to jump on over to the financials tab. We're going to be looking at the income statement. I'm going to break this down on a quarterly level. That way you can kind of see like what happens in the Q3 earnings. Their revenue, also referred to as the top line, because when you take a look at the income statement, right? The gross sales, that's the first line item. Do you see it? That's why it's called the top line. And then the bottom line is the EPS, the profits per share. Essentially, after you take all of these deductions and overhead costs to run the operations, what goes into your pockets on an accounting level? Not on a cash flow level, because that's what the cash flow statement is for. But anyways, their top line, it went up by 14% year over year. So when you look at Q3 of 2024, it was $4.1 billion, which is pretty good, right? But leading up to Q4 of 2024, they were always declining year over year, right? So that's why the comeback story, this is where it begins in 2025 when things are looking a lot better for this company. And what makes this $4.7 billion so special is that the analysts, they were expecting $4.6 billion. So they smashed past the forecast. And as I scroll down the income statement, I mean, you could take a look at all the various line items that are deducted from the gross sales. Like this is the total amount of money they bring in, $4.7 billion. But then, hey, the cost to do business is $2 billion. So right off the bat, you have $2.7 billion of gross profit. But then, hey, you also have to pay your workers a fair compensation, right? Otherwise, they're going to jump ship and go to your competitor or peer. SG&A is basically the compensation that you pay for the employees. That was $463 million. And then you want to stay relevant and be engineering instead of staying stagnant. So you're going to be spending $518 million on R&D and so forth, all the way to the bottom. That is the profits. That's the earnings, the net income. That's the bottom line. Usually in an income statement, that's the last thing that you'll see. But because this is stock analysis, they also give you a ton of different data points. But this is usually where it stops. So $1.3 billion of profits. And when we take into consideration the earnings per share, so basically you're going to divide that number of $1.3 billion of profits by the amount of shares outstanding, which is 914 million shares. And that gives you the EPS, which is also referred to as the what? The bottom line per share, also referred to as the what? The profits per share. And in this case, the GAAP way of saying it is the earnings per share, $1.48. However, for Q4, this current quarter that they're operating in, they've got about a month and a half to go. They reduced the guidance for their EPS going forward. And I'm so sorry. It's like 6:30 a.m. I literally just woke up, so maybe the brain is not firing on all cylinders. If we jump on over to the metrics tab to take a look at how things are going, and you look at it on a quarterly basis, dude, that's pretty phenomenal growth. The analog chips, 15.7% growth. The embedded processing chips, 8.5%, and then other. That includes their traditional modality of selling calculators and other handheld devices. That went up by 10.5% as well. So across the board, it looks pretty good when we think about the revenue situation. So what are my takeaways from their most recent earnings? I thought about it. If the AI data center movement keeps growing, and we have every evidence that it is, right? Because the hyperscalers like Amazon, Meta, Google, Microsoft, they've been posting and they're saying, dude, we need to increase our CapEx to build out more data centers. Then Texas Instruments is going to benefit as well because as we talked about earlier, they're supporting the data center equipment. No, they're not necessarily going to be utilized for the very powerful GPU chips that just so happen to be complex as well for NVIDIA and AMD because that's going to be Taiwan Semiconductor Manufacturing, TXN. They're the ones that make the very powerful GPU chips. However, just as important, well, actually, I take that back. However, in a secondary fashion, I think the analog and embedded processing chips are just as important. So Texas Instruments should also benefit as long as these hyperscalers continue to spend 50, 100, and in Meta's case, $600 billion on CapEx. But I do want to throw this out there. It's not just the semiconductor chip companies that are going to be benefiting from the data centers scaling and expanding and growing. Because I also think the HVAC businesses are going to be thriving because to have a data center be up and running and not overheat, you bet there's going to be a lot of cooling and air conditioning and ventilation systems in place in those warehouses. But I also think power utilities, because how can a data center be up and running if there's not solar panels, if they don't have a dedicated power source? That way there's no outage. And IT infrastructure companies like Cisco, yeah, they're also going to be benefiting as long as these data centers keep on expanding and growing. And now at this point in the video, let's go ahead and calculate what the inherent worth of their stock price should be based on their own numbers and fundamentals. The first one is going to be the dividend discount model. Their dividend profile and the growth rate of their dividend is going to tell us how much their stock price should be. And I want to take a quick tactical pause because as I looked into their dividend profile, the numbers don't really add up. So having said that, let's jump on back over to stock analysis to show you what I'm talking about. So let's jump on over to the dividends tab. Their dividend yield, 3.4%. I think Google Finance said 3.5%. That's a negligible difference, meaning for every share of Texas Instruments that you own, you're going to get $5.44 in dividends per share. I'm not going to lie, that's pretty juicy. For a semiconductor chip business to pay a dividend yield above 3%, I like it. And the dividend growth rate being 4.5%, I like that as well. But what does not add up to me is that the payout ratio is 100%. And what I mean by that is, remember this number, $5.44 of dividends paid out per share. If we jump on back over to the income statement, that payout ratio is calculated using the EPS. So $5.49, effectively 99.2% or something like that of their profits per share have to be utilized for the dividends. That's pretty freaking bad. And it gets worse because when you consider the cash flow statement and we take a look at the free cash flow situation, the free cash flow per share is $2.27. So there's no freaking way that the free cash flow would be able to cover the dividend. And for the net income per share, you're almost utilizing all of your profits to go towards the dividends. So no matter how I look at it, the math is just, it's not really adding up. So why did Texas Instruments make the executive decision to increase their dividend payout, right? 4.5% growth. They made that call October 31st. It went up from $1.36 to $1.42. And what I do want to show you is they've been growing their dividend for the past 21 years. So during the Great Recession, during the pandemic sell-off, during the April 2025 craziness, they've been increasing their dividend up and to the right. So I think what's happening right now is they're using probably 50 to 60% of their EPS plus the cash on the books plus a little bit of debt in order to finance the dividend. Because if I jump on over to their balance sheet, they have about $5.1 billion of cash and cash equivalents on hand. What's the equivalence part? Money that's put into something that's very liquid, like a money market fund, a CD, a high yield savings account, something that generates like a 2, 3, 4% yield on your cash. That way you're not just losing purchasing power of letting your cash sit idly. When you look at their cash and cash equivalent situation, in 2021, it used to be $9.7 billion, correct? However, it's been shrinking inevitably every single year. And that's why I'm thinking they're using, I guess in 2022, 6.9% of the cash on the books in order to help bridge the gap and finance the dividends, and then 5% in 2023, and then 11.6% in 2024, and then 40% in the past 12 months. I do not like it. I absolutely hate that Texas Instruments is using financial engineering and getting creative in order to afford that dividend. Now, I'm not insinuating that they should cut the dividend like Intel did. Intel is also very similar to Texas Instruments because they also operate in the semiconductor space. And as I made my deep dive video like 9 months ago, I said that the United States government is not going to allow Intel to fail. And sure enough, now Intel stock has been pumping for the past like 2 months or so. Same with Boeing. Even though Boeing has a lot of quality control issues and they don't treat their workers right, because as their CEO's compensation went up like 30 or 40% year over year, their workers, the ones that are on the front lines running the operations, their pay increase was like 1% year over year. There's so much I don't like about Boeing, but it's so important to keep Boeing up and alive to protect America's interests that America will continue to bail them out again and again, just like Intel. So when I think about their financial situation of Texas Instruments, I'm not in love with this, okay? As you can see, their debt, look at the growth of the total debt, how leveraged they are year over year. I have reasons to believe that they're using a lot of debt in order to finance the dividends as well. So I'm not insinuating that they cut the dividend like Intel, but couldn't they have just stopped growing it and make the decision to just maintain it? I don't think any shareholder would have been pissed off at getting $1.36 every 3 months. To grow the dividend and taking on more loans and using practically all of your profits to pay the dividend, I don't like that. Friends and family, you can't ignore it. This is a yellow flag. However, one thing that I do want to call out is that their free cash flow situation, let's take a look at it. So up until like 2022, it was stellar. $5.9 billion of free cash flow. That's the actual cash that's left over after you fund the operations. There's no financial manipulation like the income statement. Look at how it drops off a cliff going into 2023. It went from $5.9 billion down to $1.3 billion. And even right now, it's still trash. I mean, yes, it's going in the right trend, but it's still trash, especially in comparison to their own history and comparing themselves to their 2022 numbers. And that's because they have been doing a lot of CapEx building out the new fab production facilities. Because up until recently, they used to outsource the production and manufacturing of their chips, but they're trying to do everything in-house, and that's why their free cash flow took a hit. But all that to say, hopefully that makes sense as to why the payout ratio is 100%. I think realistically, it's probably closer to a 60 to a 65%. Because they're using 60 to 65% of the EPS to pay for the dividends, and then they bridge the gap for the other $1.75 or $1.85 by the loans and the cash that they have on the books. I know, sorry, very long-winded way to say, now let's look at their DDM intrinsic valuation. I said it already, but I want to repeat myself like a broken record because I think their dividend profile is phenomenal, besides the payout ratio. And what I mean by that is the growth rate of their dividend payout, pretty impressive. However, going forward, I don't think they're going to be able to maintain a 12% year-over-year growth like they did from 2021 to 2022. I think it's going to stay at around that 4% mark, especially as they continue to utilize almost all of their money to build out the production facility. So even though objectively the dividend is growing at a rate of 8.6% year-over-year for the past 5.5 years, I'm going to plug in a number that's closer to 6%. And my reasoning is that it kind of bridges the gap with that 4% number that I really do want to use and 8%. What's in the middle? 6%. Now, predicated upon their dividend growing at a rate of 6%, that means you're baking in that in the future, sometimes it'll be 4% and sometimes it might be 8% for the growth rate, right? Then Texas Instruments should be $162 a share. At the time of making this video, I think Texas Instruments right now is $159 or $158. So having said that, they're pretty much trading for the price they should be. I mean, slightly undervalued, but by like what, 1%? Now, the next inherent worth calculator is going to be predicated upon the profits per share. I'm going to go on record by saying this is my most preferred way to evaluate a company. And by the way, if you want this spreadsheet, it's up and live on the Patreon. It's up there. So you can download a copy and mess around with it if you want. Just hop on over to the Patreon. So when we take a look at the objective numbers that Texas Instruments has posted in 2025, it hasn't been terrible. However, the reason why I have Q4 highlighted is because going forward, this current quarter that they're operating in, like we said earlier, their guidance has been disappointing because they're projecting their EPS to be between $1.13 to the upside of $1.39. So the midpoint, $1.26. Now, why am I saying that was disappointing? The analysts, well, they were expecting $1.41. So, like I said, you have to understand the EPS in order to truly analyze the PE ratio, because they're related, right? And because of that disappointing guidance, that's one of the reasons why Texas Instruments, since they posted their earnings, why they're selling off. So how bad is this? It's a 3.9% drop year over year. Because in Q4 of 2024, last year, exact same time period, it was $1.31. For a company that's operating in the semiconductor space, you need to see the numbers growing in the green up and to the right. Correct? But for Texas Instruments, for it to be dropping from $1.31 to $1.26, it's disappointing. Now, at the time of making this video, Texas Instruments' current PE ratio is a 29. However, I'm not saying that I'm bearish, but once they do finish out their operations this year and they post their results, I think there's going to be an immediate sell-off because their earnings per share, that projected with that $1.26 in the midpoint, is $5.43. So I'm thinking their PE ratio in the next month and a half to 2 months, it's going to drop to a 25.5, which unfortunately means that their stock price will go from 159, what it is right now, down to 138. However, it is important to note that historically, Texas Instruments' PE ratio, past 10 years on average, is a 27.9. And if you only consider the past 3 years, then on average, 29.9. So for them to be operating with a PE ratio of a 29, it tells me once again that Texas Instruments is operating at a fair valuation. But if they post a 27.8 and they drop slightly from the 29 that they are right now, then Texas Instruments could be $150 in the next month and a half to 2 months. And if we continue to play this game and we move down to 2027, one thing that I do want to note is I read somewhere, I think it was on Morningstar or The Economist, I can't remember. There's an expectation out there that Texas Instruments earnings per share should be at a minimum $8 in 2027. Now, the expectation from the data that I extrapolated from stock analysis, the average is $7.65, but it does go as high as $10.52. So I personally don't think that $8.01 is outrageous. It's slightly above the average, but it's still in line with the numbers, the parameters that we're working with. The bottom is $5.93. Now, if I were to plug in $5.93, then I'm obviously being biased and very negative and bearish. However, if they post $8 in 2027 and their PE ratio is a 27, then Texas Instruments could jump back up to $216 a share. Best case scenario with a 29.9 PE ratio, then a $239. And if we jump on over to the next year in 2028 and they post $8.97 of profits per share and they trade for a PE of a 28, then $251 a share. So the upside from 159 to 251 in a matter of 3 years, it sounds pretty good. However, the reality is right now, I don't think they're in their value. However, if Texas Instruments does post $5.43 as their EPS and they close out the year at a PE of a 29, then they could be around 157, which means they're slightly overvalued right now by $1 or $2. However, let's adjust some numbers and talk about Texas Instruments in a more optimistic light. So they're saying, hey, Our earnings per share for Q4 can be $1.13 all the way up to $1.39. Let's go ahead and assume they smash it out of the ballpark and they hit $1.39, which is the upper range estimation. Let's see how the numbers get adjusted. Then Texas Instruments could go from 159 to 161, which is an upside of $2 if you buy into Texas Instruments right now. Obviously, when I say that, that's not a 100% biblical truth. Okay? That doesn't mean it's going to come to fruition. Anything could happen. Sometimes, like in PayPal's case, they posted stellar numbers. The reason why I'm talking about PayPal is I spent the past 48 hours making a heavy back and forth decision on whether or not I wanted to jump in. And ultimately, I made the call not to do it. They've been posting stellar numbers, and they even initiated a dividend, which I kept jumping up and down saying they needed to. They even pay a dividend now, but it doesn't matter. The stock market, they don't like PayPal. So their valuation is tanking, their stock price is just selling off, and their PE ratio, I think it's something ridiculous. Let me just pull it up. I think it's a teen number. Their PE is a 12. For a company that's at the tip of the spear of the fintech space, to have a 12.6, that's why I'm saying what you see on your screen right now should theoretically be what should be happening. But it doesn't matter. If the stock market changes how they feel about Texas Instruments, their PE could absolutely drop to a 25.5, which I'm projecting it will. So 159 down to 141. But if they continue to keep them at their historic PE ratio of a 29, then 161 in the next month to 2 months. I know it might not be what you want to hear, but it's what the numbers are saying, because the data and the numbers, they speak an objective story. Because I know there's a lot of YouTubers and people out here that make an investment decision by just looking at the products or walking through the store doors and saying, wow, I see some people here, I'm going to buy into it. On the other hand, I think that's also helpful, maybe at a 1% of the decision-making process. But I also think it's really crucial, and it might behoove of you to understand and look at the numbers to see what the numbers say. I think just like most things in life, it's about being balanced, especially in your approach on how you do anything, right? You don't want to be too gung-ho in one direction or one philosophy or one political stance. Like, if you're the type of person to eat 7 plates at a Chinese all-you-can-eat buffet, you might as well get the Diet Coke or the Diet Pepsi. Please, I'm a PepsiCo investor. I guess that Diet Pepsi would help the pendulum to be a little more balanced after you down plate after plate of lo mein, sushi, fried rice, General Tso chicken. Dude, I'm getting hungry. So when we think about Texas Instruments, where do they belong on the compounder chart? Now, to just quickly explain what you're seeing on your screen right now, all the way to the left is the S tier. I would argue certified compounders. Your money invested into Google or Amazon, it's going to inevitably compound in XYZ amount of years. That's not financial advice. That's just one idiot talking to himself because I might be schizo. You move on down, Meta, right there technically should be the letter grade of an A. Superior, excellence, and above average. The next category I would say right here is the B tier. Still pretty good, right? I've got United Healthcare, Salesforce, and Oshkosh Corporation. And then over here, like Clorox, General Mills, The Trade Desk, and Adobe, and Chipotle, C+. I think Chipotle might be closer into the C tier, but C tier does not mean that a business operation is bad. Because PayPal, Lululemon, Sezzle, Duolingo, their numbers look phenomenal. Seriously, you can pause this video right now and look up any one of them and look at the analysis that I made for that company. And I say that, they're pound for pound, their numbers look beautiful. But it doesn't matter because the stock market, hedge funds, and Wall Street, they don't like them. So if the big money doesn't pump into it, that stock price is just going to be stagnant or even decline. And that's why I have them in the watch list, wait list, a grade letter of a C. Because even though their numbers are fantastic, Wall Street just, they don't like them. And then all the way to the right is the F tier. I truly don't think it's a wise utilization of my capital to put it into Chime Finance or Carter's Baby Clothes. Not smart. Now, having said that, where do I want to put Texas Instruments? I think, as we learned at the beginning of the video, with their stock price, there's highs and lows, it's very volatile. I mean, the past 5 years, to see an ROI of 1.7%, I don't know about you, but to me, that's unacceptable. I think what really bothers me, like a pebble in my shoe, is that Texas Instruments, I mean, I love that they operate in the AI space, but fundamentally, it's still the semiconductor operations, right? And historically, the semiconductor business operations, very cyclical. There's highs and lows depending on inventory levels, demand, and the market cycle. And here's where I'm trying to come from. I think there's a lot of tension between US and China, right? Every other day you hear about tariffs being thrown around. We need to cut it out with that because I feel like everybody wins if free trade is promoted. The more that we keep penalizing our trade partners, the worse off everybody is. I don't know. But I might be wrong, but if trade tensions continue, then I think customers in China, they're going to gravitate toward just buying their own Chinese-made analog and embedded chips by Chinese companies instead of saying we're going to import it from Texas Instruments. And that's why I'm like, And I think that thought process is also supported by the fact that it seems like every other month, the current presidential administration, they keep putting restrictions on what chips NVIDIA and AMD can export, right? And so that's throttling the potential of their growth and revenue. And I don't think it's just exclusive to them. I think it's also affecting everybody. So I think thinking about all of those factors, Texas Instruments for me is going to be right next to Chipotle, a C+. Depending on my mood, I might even put them into the watch list, wait list, and just stamp them with a C. I personally do not think that Texas Instruments is undervalued right now. They're about the price they should be. Now, if I think about it with an optimistic lens, I do think they have the potential to hit 165 or maybe even like 170 a share. But realistically, I think 157 to about 161 is what Texas Instruments should be. I mean, the PE does not lie. It's at a 29, 159 a share, year to date, negative 15%. What I'm trying to say is that I do like Texas Instruments because right here, a 3.4% dividend yield, the growth rate phenomenal. I really like them, okay? Because I think in the future, we are going to continue boosting, pumping, and supporting the U.S. infrastructure in order to manufacture and produce our own chips. Because I think talking about the U.S. and China tensions, I think there's a lot of tensions with China and Taiwan. And right now, most of our complex chips are being manufactured overseas in Taiwan. So if anything were to happen, dude, that would be a supply chain catastrophe. So I personally see the trend going in that we're going to be producing our own chips more and more. Intel, Samsung, TSM, and Texas Instruments. But the point that I'm trying to get at is, if we take a look at their stock market performance past 5 years, Texas Instruments, yes, it's a high quality company, but their performance in the stock market, it's kind of like sticking your wiener in a blender, right? And putting it onto the chopped ice setting. It's not fun. So thinking about all of the factors, I feel like my money would be better invested into water stocks, utilities, Procter & Gamble, or even into a Bitcoin income paying ETF. That's just where my head is at. Now, I will caveat that by saying, if I were closer to retirement, I'm 35. I'm in my mid-30s, but if I was closer to retirement, I wouldn't mind putting some capital into Texas Instruments because of that juicy dividend yield. A 3.4, 3.5%, I think it's pretty good, especially the growth rate. I like it. And if the share price happens to go up, that would be sick. I wouldn't be investing into Texas Instruments for the share price appreciation. I would be investing into them for their dividend. However, I'm nowhere close to retirement. So when it comes to Texas Instruments, after spending the past 2 to 2.5 days looking at them and analyzing everything that there is to know about this company, I'm going to make the hard decision to pass on this one. I'm just going to delete them from my watch list. But What am I missing? If you are bullish about Texas Instruments, I'm not a hostile guy. I'm not looking for arguments. I'm an open-minded guy. You've seen it on the channel before. If in fact there's information out there that I wasn't aware of, that could change my decision in my mind, right? So what am I missing? Why is Texas Instruments good? Like, why should I pick Texas Instruments over, I don't know, Skyworks Solutions or Lam Research Center or Applied Materials or into TXN? Why Texas Instruments? I'm genuinely asking. I'm not saying that to be condescending or to be like a know-it-all or to make fun of you. No, I genuinely want to know because I think there is potential here. It's just all of the data points to me saying no. So, I don't know. Anyways, I love you guys. Stay safe. Good luck in the stock market. And I really do appreciate you supporting me in the channel. So, thank you. Peace.